All right, and it looks like we are live. Let me know if you guys can hear me. I know there's, again, a little bit of a lag between when I'm talking and when you guys are hearing me. But let me know right off the bat if you guys can hear me, and we'll go ahead and get started. This week, we're talking all about something that we call the retirement red zone. Okay. And this retirement red zone essentially happens at the beginning of your retirement and leading into retirement. And I think it's and the data backs this up, it's the most important period of your entire retirement. Okay. So we're going to be talking about the math behind this retirement red zone, what it is, and how you guys can position your retirement to have success for years to come. Okay. So, what is the red zone? Okay. So, while you're working, from the time that you start working your job, in your 20s to when you retire, typically in your 60s, maybe late 50s, you're in the accumulation zone. Okay. Your goal is to just gain as much as you can into your retirement nest egg so that you are ready for the back half of your life. Well, the 5 years before retirement and the 5 years after retirement is something that we call the red zone. Okay. And it's the most important period of your entire retirement, both from an investing standpoint as well as a planning standpoint. Okay. So in this presentation, we're going to cover basically the math behind this red zone and investing in this red zone and how it can go wrong and set your retirement off on basically a bad course. And then we're also going to talk just touch on the retirement plan improvements and decisions that you have to make in this red zone to improve your retirement, again, for years to come. We're going to be focusing majority, though, on this investing math and talking about investing allocations. So I think right now, retirees, and I would guess the majority of people in this group fit into this category. Those retiring and are in the red zone right now or about to retire. Either way, 5 years before, 5 years after, you'd be in the red zone. I think you guys have some unique challenges that generations before you might not have had. Okay. The first one is a potential stock market crash looming. Now, granted, we had a stock market crash last year in 2020, but it was a very fast and strong rebound. Okay. And normally speaking, we expect bear markets, financial or economic crashes to happen every, I would say, 6 to 10 years. Okay. Well, the last huge one we had was in 2008. Before last year, it had been 10 years. And some people think because we rebounded so fast from last year and because the government pumped so much money into the system that wasn't really a real bear market. So is there one looming in the future? Okay. And again, no one knows the answer to that, but it's definitely a cause for concern. Low yields. Okay. In the past, a retiree could easily add safety to their portfolio. They could go invest in a CD or a bond and earn, 5 to 7%. Well, now what do those bonds and CDs earn? 1%, 2% at most right now. Okay, you guys are going to be the longest living generation, needing your money to last longer than prior generations before you. You guys have fewer pensions statistically than generations before you because of all this money printing and infusing into the system. Higher inflation is a real risk. Future tax hikes, again, taxes are extremely low. Debt's rising at some point. Tax hikes could be a potential challenge that you guys face. And then we live in a great time where there's more information than ever. Okay. The reason we're able to do these Wealth Wednesdays every week is because of technology, because we're able to broadcast these to, over 300 people. And that's great. It has some great upsides, but the downside of that is anyone can blast out information, whether it's correct or not, to a ton of people. And so there's also a lot of misinformation as well that creates a challenge in this red zone. Okay. Well, what I want to talk about today are essentially the two phases of your financial life and how many of you are familiar with this accumulation phase. Okay. And how the math and basically everything changes once you cross over the mountain and enter into the distribution phase. So oftentimes you'll see retirement savings illustrated like this, as if it's a mountain. Okay. And in the accumulation phase, you're earning money, okay, from the time you start working to the time you retire. you're earning money, you're putting it away, you're saving for the future. And then basically the top of the mountain is often thought of as retirement. It's a day that you retire and you start essentially climbing back down the mountain. And again, a lot of things change. No longer are you saving, you're withdrawing from those assets. So essentially, and again, this isn't going to be the case for everyone. Some people's retirement savings will continue to grow from here on out. But generally speaking, this is how people like to illustrate your retirement savings from accumulation to distribution. And so I'm going to talk about these two phases and how the math changes. But before we dive into that, just kind of a quick definition so everyone's familiar when I use it ongoing through this presentation is a concept called volatility. Okay. And this is a common finance term. And basically volatility is just the measure of essentially the roller coaster ride of your investments. Okay. So higher volatility means that it's a much lengthier, if you will, roller coaster, meaning you can have very high highs, but it can also, your investments can be down significantly the next day. A less volatile portfolio will chug along, if you will. It will grow much slower, but you won't have as much of that roller coaster ride. Okay, so when you're in the accumulation phase, volatility is great. Okay, there are two things that are the most important factors to building wealth in the accumulation phase. Okay, and it's we're going to simplify it. I'm probably going to simplify it a little bit too much, but it's not that far off of this. Okay, two important factors: your savings rate. How much are you adding to your 401k, to whatever investment account you are using to save and invest for the future, and then your growth rate. Okay, the higher your savings rate, the higher your growth rate. Pretty simple, the more money you're going to have going into retirement. Okay. And so when you're in the accumulation phase, you have time on your side. And so because you have time, you're able to take more risk. You're able to add volatility to your portfolio. And typically, the more risk you take, the higher return that you have. And so again, if you were working in 2008, and again, the market crashed 50% at one point. So whatever amount of money you had at that point, cut in half. That wasn't the end of the world while you're working. You're not living off that money. And so you have time to wait for it to recover. And so why is volatility good then? Well, if you think about it, when you have a lot of volatility, again, markets high at one point, and then in 2008, market crashes significantly. Well, the entire time that the market is losing money, you're continuing to add to your investments. Okay. And so at the bottom of 2008, the S&P 500 was at similar levels that we saw in the 90s. Okay. So if you're investing at the bottom of 2008 and you're continuing to add money to your investments, you're essentially buying into the same market, if you will, that we had in the 90s. And so, if we could go back in time and I could ask you, okay, in 1995, how much money would you like to invest? You know that from 95 to 2000, market went straight up. You'd say, I want to invest a lot of money. Well, in 2008, you're back at those levels and you're adding money in it. So it's dollar cost averaging. And so volatility is great during those time periods. Okay. And so just to kind of give you, and I'll move my, my marker or my face over here, just kind of give you a little bit of an idea. What I'm showing on this chart is a 30-year run in the stock market based on a bunch of different starting years. Okay. And I'm just assuming that you start out with no money and you start adding $5,000 per year. Okay. And this chart right here shows the average ending value, or it shows the ending value of each of these periods. So for instance, in 1950, you start in 1950 investing, you start adding $5,000 per year, just investing all of your money in the stock market. And at the end of those 30 years, you have, call it $750,000. Okay. We go over here, 1970, same situation. You're investing the same amount of money, but there was a better run. So that starting in 1970, by the end of 2000, that same 100% investment into the market, you have over $2.5 million. So what I want to show here is the average amount that you would have left in this accumulation phase, just taking some risk by putting all of your money in the stock market and adding to it each and every year, trying to go for the highest growth rate and just trying to keep on, continue to save. on average, you would have almost $1.2 million at the end of those 30 years. Excuse me. Okay. And so again, in this accumulation phase, you can afford to take risk above and beyond your risk tolerance. Okay. The best thing that you can do, or that the best advice you can give to your kids or grandchildren, is to have a high savings rate, aim for a high growth rate, and just don't check it. Don't meddle with it. Don't try to beat the market. Just let it continue to save and let that stuff ride. Essentially, just continue to save dollar cost average. And across all of these periods, on the lowest side, again, we're looking at over $500,000 just saving $5,000 per year and dollar cost averaging along the way. Now, if somebody wanted to, if I was going to say, okay, I can't deal with the ups and downs of the stock market, even in the accumulation phase, if you were to invest in a 60-40, so 60% stocks, 40% bonds, and so you're allocating 40% to a safer investment, you can see that almost regardless of the time period, or regardless of when you start, adding safety hurts your overall performance. Okay, and again, this makes sense when you're in the accumulation phase. You're not having to withdraw any money. And so again, volatility is good. The more money that you can save each and every month, the higher growth rate. Across the board, you end up with more money. And so again, just trying to simplify, if you're continuing to, or if you have someone that's a son or a daughter that's working and wondering how they can make the biggest difference by the time they retire, is just continue to save and then continue to invest in more aggressive investments. Okay. Problem is, once you get closer to this distribution phase, the math starts to change. Okay. That's why the red zone starts 5 years before retirement. 5 years before retirement, you need to add safety, okay? Because on the other side of the mountain, everything changes, okay? And therefore, your retirement plan, your financial situation has to change as well. So what's important in the distribution phase? Well, two most important factors to a safe retirement, rather than savings rate, it comes to withdrawal rate. So on the accumulation side, how much you were saving. Now it's how much are you withdrawing each and every year in relation to your overall portfolio size. Okay. The higher withdrawal rate you have, the worse off your retirement plan is going to be. Okay. You want to have levels of safety, if you will, in your plan. And then growth rate is still just as important, because we still need we essentially need income raises in retirement due to inflation. Okay. So let's say this year you need $100,000 for retirement income. If inflation is 2.5%, next year you're going to need $2,500 more dollars in order to keep up with the same standard of living that you currently have. Okay, and this inflation is going to eat away at your wealth each and every year. So you need growth to overcome that inflation, but you don't have time anymore. So you need the safety. In a 2008 environment, if you have all of your retirement savings in the stock market, you can't call the utility company and say, hey, my investments took a huge hit these last few months. Wondering if you could just hold my utility bill till, like, I don't know, 2010, 2013, when the markets come back a little bit more. No, you can't do that, obviously, right? You have bills to pay. You have needs each and every month in retirement. And so you don't have the time. Okay. And volatility is bad, because no longer are you dollar cost averaging. You're essentially dollar cost withdrawing from your assets. Okay. And these withdrawals, again, change this math. Okay. So let me back up for a second. I will say that there are different types of retirees, okay, with different situations. Okay. So I've got three types here. We're actually going to start at type 3. Okay. So at type 3, and just so you know, POS means probability of success. So when we run a plan under 1,000 tests, 1,000 simulations, how many of those simulations were successful, that this person's retirement savings met all of this person's goals? Okay. And so type 3 would be someone that's more of what we would call an optimization plan. Okay. So this might be someone who has pensions, who has Social Security, and the majority, if not all of their income is covered through those two sources. And so they might still have $500,000, $1 million on top of that. Okay. And so in these type of situations, their investing situation looks much more similar to the accumulation phase, than the distribution because they don't have a significant need from their retirement plan. And so they can take a lot more risk and invest a lot more aggressively for growth than the other two types that we're going to talk about. Okay. The other two types, type 2 would be someone with a very stable retirement, but still has some risk. So they have an 85 to 95% probability of success. They've done a great job saving relative to how much income they want, but nothing is guaranteed. Okay. A significant drop in the market, or if lower returns, if future returns are lower, this person might run into some greater risk in their retirement. And then type 1 would be someone that has a close retirement. Okay. Meaning that for whatever reason, their savings relative to their how much they need for income doesn't leave a lot of room for decisions to wrong decisions to be made. Okay. And this would be someone with 75 to 95% probability of success. So the rest of this presentation, until we get to the planning part, is basically going to be focused on type 1 and type 2 and how they should invest their money. Okay. And how the math changes again in this distribution phase. So two common misunderstandings that I see both from financial advisors and also from retirees is that a lot of people focus on average return. Okay. So for instance, while they were in the accumulation phase, they did very well. They stayed diligent, and maybe their investments grew by 9% a year or something like that. Okay. 8% a year, whatever. And now they think, okay, if I just continue to get that in retirement, I should be fine. I should be able to take 4, 5, 6% from my assets, and I should be fine. And this is just a huge blunder that I see so many people make. Okay. Number 2 would be that I can just wait out a loss. Okay. Maybe you have some pretty significant risk tolerance that in a 2008, hey, over the long run, the US is still going to end up on top. So I can wait out a 2008 type loss. I can do the same thing in retirement. And again, these are two blunders that I see people making in the distribution phase because they're acting like the distribution phase is just like the accumulation phase. Okay. And what I want you to think about, okay, kind of more from a theoretical standpoint, is how much is your retirement depending on one 10-year period of performance? Okay. So let's say that this graph right here, or this illustration right here, represents your retirement savings. Okay. So you have you're a type 1, type 2 type retiree. And so you've saved a bunch of money, and at retirement, you're taking enough from your assets that your retirement assets are going to go down over time. Okay. Well, if you think about it, if we just kind of try to illustrate a red zone right here, 5 years before and 5 years after, when is the time that you're going to have the most amount of money saved for retirement and investing in assets for retirement? It's going to come in this 10-year period, right? The 5 years before and the 5 years after. Okay. So let's say you are 100% stocks this entire time. Okay. And now you're going to stay 100% stocks during this time period as well. Well, this 10-year period of performance will determine basically how your retirement goes. Okay. It's because when you're going to have the most money invested during this 10-year period. And so, regardless of how well the last 20 years went, that doesn't matter. It matters how the next 10 years are going to go for your retirement. So what if you have bad timing? Okay. And you retire at the wrong time. And I say that in quotations because we don't know when the right time is going to be. We don't know what future performance is going to be, but the wrong time would have been someone retiring in 2000. Okay. And let's say this person had a significant amount of money invested in the stock market. Well, we know what happened. Okay. We had the tech bubble in the early 2000s. We had 2008 financial crisis. And so this person's retiring here and going to be withdrawing money from their portfolio each and every month. Okay. And if they have a huge stock allocation, we know that the market dropped 50% going, I should probably change my color. Doesn't really show up. Okay. Oop. So we know that the stock market dropped 50% here. Stock market dropped 50% here. And this whole idea of just waiting it out doesn't work in retirement because, again, you're having to take income out each and every time during this period. And so let's say going into retirement, you've saved the most money that you've ever had in your retirement savings. Let's say it's $1 million. Okay, well, as you're taking money from your portfolio during this time, this performance alone cuts that money in half. But remember, you're taking withdrawals as well. And so by the time you get down here to the market bottom, you might be down 60%, 65%, because you've been taking withdrawals the whole way. And so as you're rebounding back, once again, you're taking withdrawals this entire way. Okay. And so those withdrawals are hurting the recovery, the rebound back. And so if you're in the accumulation phase, by 2008, 2007, the market got back to break even. But when you're in the distribution phase, you're never getting back to break even because you're taking those withdrawals. You took withdrawals over here and you're taking withdrawals the entire way up. So you might end up, by the time they get back to this point, from the initial starting point, you might still be down 25%. Okay, let's just try to draw 25% here. Okay, and then again, what happened next? 2008. And again, this entire time, you're taking withdrawals. Okay, and so market's down 50% again. You might be down closer to 75% by that point. Okay, because you never made it back to break even. And now, again, you've made it through, call it 10 years of retirement, but you have 20, 30 years left potentially. Okay, and so this is why you need that safety in retirement, because of these withdrawals. You can't simply wait it out, if you will. Okay, you don't have the time, and you're taking withdrawals that are hurting your performance, both on the decline and then again on the recovery. Okay, and so how much of your performance is coming from this 10-year period? Okay, how much of your retirement is relying on that 10-year performance? Okay, so again, between these two phases, let's say you invest aggressively, again, in a more volatile portfolio. Okay, well, given the choice here, where would you want to take income? At the X or at the zero, or at the circle? Okay, you'd obviously want to take it at the X. You want to take it when the market's as high as possible. Okay, and now, granted, we don't know what's on the other side, if the market's going to continue to go up or go down, but given perfect hindsight, we would rather take at the X versus zero. Well, again, we don't have that opportunity to choose. We have to take it each and every month, and we need that income in retirement. Well, let's say we have a safer portfolio. Okay, given so this green line, given this choice, where would you want to take income? It doesn't matter as much, right? Because we're still going up, we still have that growth, but we have more safety. So the timing of when we take our income doesn't quite matter as much. And so this is why in the distribution phase, you absolutely need safety. Okay. And so the big issue that I often see are people looking at just average performance without thinking about volatility. Okay. And they're assuming average performance happens statically. I'll show what that means in a second. But average performance, when you're in the accumulation phase, it matters. Okay. When you're in the retirement phase, distribution phase, it doesn't matter. Throw it out the window. Average return literally doesn't matter. Sequence of return does. Okay. So let's go through an example. Let's say you're invested in a 60-40 portfolio. Okay, and the period I'm showing on the screen right now is 1973 to 1993. Okay, and that seems like an odd period. Well, I cherry picked that period for a very specific reason. The reason is that a 60-40 portfolio had a fantastic run over these 20 years, averaged over 10% per year. And so, going over the next 20 years, we would all be thrilled if a 60-40 averaged 10%. I don't know if we could possibly get there unless we see amazing stock market performance, but nonetheless, this period of time we picked because 60-40 did great. Okay, so when you're in the accumulation phase, you're not taking money from your portfolio. The order of returns doesn't matter. Okay, so from 1973 to 1993, we see this blue line here. We end up with $100,000 turns into $720,000. It doesn't matter if we flip the returns and go backwards from 1993 to 1973. The same thing. 100,000 turns into 720 over this 20-year period. Okay, so If we were going to go through the same period and we were going to take withdrawals as if we're in retirement, I would think earning 10% a year, we should be able to take what, 5% from our portfolio? Again, that would leave 5% for growth to outpace inflation, and then 5% for income. So we should see our assets continue to grow, right? What we do in one period, okay? From 1973 to 1993, taking that 5% per year withdrawal, we end up with no money at the end of 20 years. It's gone. And again, we know your retirement is going to need to last 30 to 40 years on average, okay? And this person's out of money after 20 years during one of the best 60-40 runs we've seen, okay? Interestingly enough, though, if we flip performance, and so at the beginning of retirement, we have the 1993 performance, and the following year we have 92, then 91. So basically, we're just flipping the order of returns. Our money grows from $100,000 to $302,000. Okay, so it was the same average performance through this period. The order of returns changed. Okay, and so this is why the sequence of your returns, the order in which you have returns on your portfolio in retirement, matters more than the average return. Okay, let's go through a few more examples. Sorry, excuse me. What is the wrong way to build a retirement plan? And I see this again too often, unfortunately, is taking a static rate, even if it's less. You know, I've seen people go, I've earned 8% on my money over the last 30 years. And so I know retirement performance might not be as great. So let's just assume 6%. And here's what I see spreadsheets. And again, built by financial advisors more often than not, assuming just a static 6% growth rate each year. Okay. And so in this, I've got portfolio size here. I've got first 15 years, just for the sake of illustration and not throwing too many numbers at you guys. $1 million starting out, and then taking 4% right off the bat, growing by 2.5% inflation. And again, I'm not saying you should take 4% from your portfolio. We've had previous recordings where we kind of debunked that whole idea, but just for illustrative purposes, let's look at 4% withdrawals, okay? And again, assuming 6% static growth here, so year in, year out, look, we know some years might be higher, some years might be lower, but average return should be 6%. So let's just run it at 6%. And so as you can see here, $1 million, even with all these withdrawals, turns into almost 1.25 million. And so I often see people running this spreadsheet on their situation going, retirement should be easy. Like, our money grows, we're taking all the income we need. This should be more than easy enough, right? I should be more than set for retirement. Well, is there a 6% CD out there that I don't know about? Because this is not realistic. Okay. And again, I'm going to show why average return, assuming this average static return, doesn't work. Okay. And is a huge blunder in this distribution phase. So let's say returns were adjusted a little bit. Now, in all of these periods that I'm going to show, we're still looking at that 6% average return. Okay. But we're going to show more of a realistic, and by realistic, I mean more just variation. Okay. So this isn't really a realistic example. I'm just showing a variation. So I'm showing a 3-year variation, negative 15%, then up 8%, then up 25%. Okay. So it's still an average 6% rate of return, but we're varying the order of returns here. Okay. So same numbers, $1 million, 2.5% inflation. But notice this, rather than having 1.25 million, okay, that $1 million turns into $810,000 through the same 15-year period. That's over $450,000 almost of a difference. Again, assuming the same average rate of return, but just changing the order of returns. Okay. And again, it eliminates $450,000 of value that when you ran that quick spreadsheet, you thought you had. Okay. Let's take it one step further. Okay. Let's say you have a bad start. Okay. So the first 3 years of retirement are all losing years. And then the later years are all great years. Okay. So first year down 20, down 15, down 10. But look, later in retirement, you get plus 25%, plus 10%, plus 22, plus 16, plus 28. So again, we're aiming for an average rate of return of 6%. Once again, look what happens to this $1 million portfolio. Just under $400,000 left. Okay. So in all of these periods, we're showing a 6% annual rate of return, average rate of return. But yet the distribution of how much money you have left after those 15 years is huge. Okay. In this example, we only have 400,000. In the first example, we had 1.25 million. Okay. And so this is why you can't assume, just static growth. Okay. We know almost no matter what we invest in, there is going to be some variation. The safer that we create our portfolio, the less variation, but nonetheless, we will have variation. Well, this is why we run retirement plans under 1,000 simulations, because we want to adjust this return period or this return order in all 1,000 periods. Okay. We want to know this full distribution of what you have left at the end, because assuming just one static rate of return, some average rate of return, does not work. Okay. And again, even within the sequence, the first 7 years, the average rate of return was different than the back 7 years. So we play this out over 30 years. If the first 15 years, you're not averaging 6%, and the back 15 years, you're averaging whatever you originally assumed, well, it doesn't matter. You might be out of money after those first 15 years. Okay. And so you have to look at you have to look at your retirement plan in multiple simulations that adjust this sequence of return. Okay, so how can you best navigate this red zone? Okay, well, 4 ways essentially. 1, allocate to safety, and I have an asterisk on safety. I'll explain why in a second. Okay, don't have such a volatile portfolio. Allocate to safety to smooth out that performance so you have less variation from year to year. Okay, ensure a smaller withdrawal rate. Okay, the more levels of safety that you have, just the safer your retirement's going to be. Taking 7% from your portfolio, you're going to rely a lot on performance versus taking 1 or 2% from your portfolio each year. Okay, use timing to create more time. Okay, and what I mean by that is basically something that's often referred to as bucket investing. Okay, so for instance, you need income in retirement. Well, create multiple buckets and invest differently based on those buckets. So your first bucket might be a year's worth of income that's just in cash. So we know no matter what, the next year's worth of income is set. Okay, that money can't go down from market performance. And so 1 year of income is set. Then there's an intermediate bucket that might be anywhere from 2 to 7 years. And we want some significant safety in that bucket, but we also want some growth. Okay, we need to balance both of those out. And then we have our 7+ year bucket. Okay, that might be just completely invested in the stock market. Okay, knowing that, look, in an average bear market, takes 5 to 7 years to recover. So even if we have a bear market today, between the short and intermediate term buckets, I know my income is set, and I can leave that bucket, that long-term bucket alone, to invest for the long term, to invest for growth. Okay. And so this is what I mean by time. Use timing to create more time. So in that long-term bucket, if we see a market crash next year, we know that our income is set essentially for the next 7 years. Okay, so we have time to recover. Use timing, taking from a specific bucket in order to create more time. So why did I put an asterisk on safety? Well, some of you watching this presentation might think, you know, he's exactly right. I can't put all of my money in the stock market. I got to put money in bonds in order to balance out safety. Well, a loss is a loss, whether that loss happens in terms of purchasing power or a dollarized loss, meaning a market loss. Okay. And so we know that the stock market, the most common type of loss in the stock market is a market type loss, a 2008, a 2020 type loss. Okay. But a loss can also come in the way of purchasing power. So oftentimes, this chart over here is the drawdown of US stocks, equities, and US bonds. Okay, so the lower, the further down it drops means if you invested, let's say over here, by over here, you had lost almost 60% of your money. Okay. And so, again, most people see equities and think there is a ton of loss that can happen because of market loss. And they think bonds are safer because market loss wise, the max drawdown for bonds has only been, call it 20%. Okay. Around there. Well, we need to be looking at losses also in terms of inflation. That's called real terms. Okay, and if we look at bonds in terms of real drawdowns, inflation adjusted drawdowns, we see that they're just as risky as stocks. Whoop. Okay, so we see here at, early in the 1920s, there was a time period where both stocks and bonds lost significantly. So if you're betting on that 20-year or that 10-year period, and this 10-year period happens to be the early 20s for you, and you were 60-40, you lost on both sides. Okay. Obviously, we see the Great Depression here. That was the single worst loss for sure from equities, but we see bonds over here from essentially from the 40s to the 80s. And what was happening during that time? Interest rates were rising. And so bonds are hurt when interest rates rise. We see bonds lose over 60% of their value. And so what I'm trying to get across is that bonds aren't as safe. Okay, now we see we don't see too many losses over here, but that's because interest rates were falling during this time period. Well, now we're at a point where interest rates are extremely low and they can either stay here, which means bonds lose to inflation on an ongoing basis, or they rise from here. Okay, which means bonds could lose both market value as well as to inflation and create a similar situation to here. Okay, now I'm not saying bonds are going to lose 60% of their value over the next 40 years, but we do have a track record of that happening in the past. And so just allocating to bonds in order to add this so-called safety doesn't necessarily add safety. Okay, we have to be thinking about inflation and market losses. So how can we allocate in order to create an investment best fit for our retirement? Well, if we had a perfect investment, what would it look like? Okay, well, it would never lose money. That would be great. It'd be 100% liquid, so we could take all of that money out of this investment tomorrow if we somehow needed $1 million, and then we'd have double-digit growth on a regular basis. Well, this investment does not exist. There is no perfect investment. Okay, and don't fall for anybody that's trying to convince you that there is a perfect investment. There isn't. Okay, but there can be a perfect portfolio built for your retirement. And so there are multiple buckets that give you 2 of the 3 benefits, but it's a trade-off. Okay, so this yellow bucket here would be that short-term cash bucket. Okay, checking, savings, CDs. It's liquid. You can take that money out anytime you need it. You have protection. It's not going to lose to the market, but you don't have growth. Okay, you're giving up growth in exchange for liquidity and protection. Okay, this middle bucket here is a bucket that we see not too many people having an allocation to. There are a few different types of investments that fit into this bucket. The characteristics of this bucket are that your money is essentially principally protected, meaning that even when the market's down in an 08 type environment, you don't lose any money. You don't gain any money, but you don't lose any money. Okay, when the economy is booming and things are going great, you get some performance to the upside. You don't get all of the stock market performance, but you get some of it. Okay, so what type of investments fit into this bucket? Well, things like you can synthetically create this type of investment with things like options and investing in treasuries. Okay, generally that gets very complex and isn't very easy to do on an individual basis. Life insurance is another option. Again, for retirees though, where they're paying significantly more for life insurance than somebody who's younger just because of their age, not a great option. Certain investments that we like in this bucket are a very small part of the annuity market called principally protected indexed annuities. Okay. Now, if you've been on any of our presentations before, you know, Tony and I hate 95+% of annuities, but there is a small portion that can offer some interesting benefits for retirees. Now, in this bucket, you get protection. Okay, you can't lose money from performance, you get growth, you get upside performance. We generally expect this bucket to do 4 to 7% over the long term. Some years it'll do 0, some years it'll do double digits. Okay. But you give away the liquidity. It doesn't have liquidity where you can take all that money out tomorrow. Okay. Now the liquidity varies based on the exact asset you're choosing in this column, but nonetheless. Okay. And then we have the C bucket, which would be the red bucket. This would be stocks, bonds, international stocks, commodities, gold, things like that. Okay. We know that can be up 30% one year, but down 30% the next. And so numerous times we've seen double-digit growth in this bucket. It's liquid. Okay. You can take all your money out of the stock market tomorrow, but you don't have that protection. It can be down. Bucket and so basically from 2000 to 2018, we show the allocation starting with 300,000 here, 700,000 here, $1 million portfolio, and we're taking that same 4% growing at 2.5% inflation. Okay, and you notice because right away we saw a pretty significant market loss, there are quite a few years where you are underwater and probably worrying quite a bit about the well-being of your retirement, and understandably so. 2008 was a huge volatile event. Okay, so right off the bat, that $1 million after year one is $720,000. But notice, even though we had this big drop in the beginning, adding safety to our portfolio helps. Okay, it helps because of these withdrawals, and by the end of these 10 years, we still have about what we put in. Okay, well, in retirement, can you essentially develop a better portfolio for these distributions? And the answer is yes. Okay, so in this situation, we're going to show 5% allocated to this yellow money bucket, 35% to the green bucket, and 60% to the red bucket. Again, short-term, intermediate term, and long-term buckets. And again, right off the bat, we know 2008 was substantial enough that we still felt that loss over here, despite having safety in both of those categories. But we noticed the recovery back happened much sooner. Okay, and growth from there on out happened after year 5, and again, there on out. And so at the end, rather than having just a little bit over $1 million, we've grown our portfolio through these distributions. And then again, it's by adding in that middle bucket, that intermediate bucket, and not accepting the lower return over here just because it's liquid. Okay, because inflation essentially is outpacing this return right now. Okay, and so let's talk just very briefly about the retirement plan decisions that happen in this zone. This is something that I talk the majority of these Wealth Wednesdays on, so I'm going to go somewhat fast through this section. But from age 62 to 72, I think is the most important planning time in your entire retirement. Okay, there's a lot of decisions that happen in this zone. A lot of people retire at 62, so it's essentially the first 10 years of retirement. Okay, making the right Social Security decision, number one. Okay, you can file anywhere from 62 to 70. And the time in which you file based on your situation, your retirement assets, will make the world of difference. This is a multi-$100,000 decision. Okay, you want to make sure you get that decision right because it will affect the rest of your retirement. Okay, Roth conversions. Okay, especially right now with the Tax Cuts and Jobs Act that's going to expire in 2026. Okay, Roth conversions, it's a perfect time for Roth conversions. Okay, also before you file for Social Security is a perfect time for Roth conversions. And why do you want to do Roth conversions? Well, one, to avoid taxes down the road, but the big one is to minimize RMDs. RMDs begin at age 72. Okay, and so from 62, from basically when you retire to 72, you want to be dealing with and minimizing these RMDs. Because as we've shown in past Wealth Wednesdays, those RMDs can cost you significant amount of lost taxes. Okay, pension decisions. If you are lucky enough to have a pension, should you take a single survivorship on it? Should you take 100% joint survivorship if you're married? Okay, when should you take that pension? Okay, there's a lot of decisions that happen that once again are going to affect your entire retirement to come. Healthcare is a big one. Before 65, the difference between what you pay for healthcare can be anywhere from $0 a month in premium and upwards of $1,800 a month in premium. The only difference is how much you report for income to the government. Okay, so you want to report as low as possible to gain significant subsidies. Okay, same thing with Medicare. Okay, you want to make sure these Roth conversions don't push you up and make you pay more for Medicare. Okay, it's like an added tax, if you will. And then again, developing a forward-looking tax plan that from the time that you retire until your retirement plan ends, that you are being as tax efficient as possible. That needs to happen at the beginning of your retirement, because if you wait too long, Roth conversions, you might lose those essentially, or lose the impact of Roth conversions. RMDs might be too significant that you can't do anything about them. Obviously Social Security and pensions and all that. If you wait too long, you don't have the same level of decision-making power. Okay. So in summary, the math in retirement changes completely. You guys are probably all familiar with the math that you guys dealt with on the accumulation phase. Well, don't be mistaken in thinking that math continues to retirement. You can't, it was a great idea potentially, we showed it was a great idea to stay very aggressive in the accumulation phase. When you cross over into retirement, that aggressiveness can be a huge blunder. Okay, you're kind of leaving it up to chance in a sense, based on that 10-year period we talked about. Average return does not matter in the distribution phase. Simple as that. It just doesn't matter. Sequence of return does. You want to make sure you add safety in the right way to make sure that safety isn't costing you something else. So you want to add safety that also provides you with some growth. And then again, that retirement red zone, the 5 years before you retire and the 5 years after, is the most important planning time in retirement. It's also the most important investment time in retirement. So you need to get those things right. I can't overstate that enough, how important this red zone is. Okay, the decisions made in this red zone will determine the fate of your retirement. And I don't mean that to scare anybody. But we've built a ton of retirement plans, some that start planning a little bit too late, and it never goes well because of RMDs, because of filing for Social Security too early, because of all the things that we have talked about. So hopefully this provided you with some interesting insight for how to invest for retirement. I see John's got a question on signed in late. Can I view later? Yes, every time we give a Wealth Wednesday in this group, it is available for replay essentially minutes after we send it. So I'll make sure I tag you in that, John. Make sure you see it. Also, I would say we're a little bit slow on it just because we've been crazy busy. But I would say a month to 2 months after we give these presentations, we put them on our YouTube channel at Safeguard Wealth Management's YouTube channel. So yes, either of those can be viewed for later. Always remember, guys, you don't need more money. You need a better plan that navigates this retirement red zone. Okay. Thanks for watching, everyone. Hope you guys enjoyed it. Hope you guys got a lot of information out of this, and we'll see you next week.